So this is a quick video on initial public offerings and pre-IPOs, and some of the strategies for buying them, some of the pitfalls, things to watch out for. So with credit to Investopedia, I just pulled this up off the web. Initial public offerings, IPO, what is it? Well, its initial public offering refers to the process of offering shares of a private corporation to the public in a new stock issuance. And key takeaways: initial public offering refers to the process of offering shares of a private corp to the public. Companies must meet requirements by the exchange and the Securities and Exchange Commission, SEC, to hold an initial public offering. IPOs provide companies with the opportunity to obtain capital by offering their shares through the primary market. Companies typically hire investment banks to market, gauge demand, and set the IPO price and data and more. You can do a direct offering, though. And an IPO can be seen as an exit strategy for companies' founders and early investors, realizing the full profit from the private investment. And that's a key takeaway, that very last line. So let's just talk about there's two sides to it. There's the fundamental side, and then there's the market side, whether you should buy them or not. So on the fundamental side, let's go back one step. So there's two types of raising the funds. There's the pre-IPO, which is the sale actually of private shares to private individuals or institutions. And the stock does not trade. Does not trade on any markets. And you have to hold the stock until the company does go public, or they register the shares in some other means, and perhaps they would list it on the pink sheets or the OTC markets. So that's the pre-IPO. The IPO is where you have unless it's a direct offering. An IPO is where the broker, canvasses their clients and say, hey, do you want some of this IPO? And you can buy it, and you buy it from the broker. Now, on the fundamental side of it, though, if it's a pre-IPO, generally it's a startup. It's high, it's high risk, and you have to, look at it yourself and see whether whether it makes sense or not. So let's talk about whether you should buy a pre-IPO. If it's coming from your cousin Vinny, who jumps up and down and says this is the best thing since sliced bread, probably not a good idea. If it's coming from somebody that you do know who is financially very savvy and has been very, very successful in the past with pre-IPOs and IPOs, or you have done them yourself and have done very well and have the ability to analyze them, and you understand that you have to, hold this paper potentially hold it for a long, long time, then you can take the pre-IPO. I have a very good friend of mine who is a very savvy investor, and he's done a lot of these pre-IPOs. As a matter of fact, him and I one of my best trades I ever did was done in a pre-IPO at 13 cents, and I sold my last shares at 9 5/8 on the NASDAQ, trading 5 million shares a day. I had 350,000 shares. But and he, so if he came to me and said, "Hey, I've got this. I'm working on this pre-IPO. Do you want some?" I'd take it in an instant. The last one he did that I was involved with, I didn't have very many shares though, but he also had 350,000 shares at 35 cents a share. Now it took a couple of years for it to come to the market, so he had that money tied up. But when it did come to market, it traded for about a year, and then got taken out at $30 a share. And he didn't have all 350,000 left at that time, but he made about $15 million on that trade on 350,000 times 35 cents times, so you put up $100 grand, right? And turned it into 15 million. Took him 5 years, but still, that's a pretty good rate of return. So if he came to me and said, "Hey, do you want to take part of this IPO?" I'd jump on it for sure. But if it's somebody you don't really know and they're just trying to pitch it and they say this is the best deal since sliced bread, you're going to have your money tied up. It's probably not worth to take the trade or to take the pre-IPO. Unless you look at the deal and you really like it really makes sense, then take some. But if they're offering a lot of stock, you have the ability to buy a lot of stock, it's probably not that good of a deal. And it all depends. And it also is key. The other key component is who are the promoters behind the deal. I wouldn't take any pre-IPOs unless I know the promoters. And if they're good promoters, then I'll take the deal. But if they're nobody I've heard of, or they don't have a track record, then I'd probably pass on it, or just take if it's coming from a friend, I'd just take a small piece just to keep my relationship with the fellow, $1,000, $2,000, $5,000 or something like that, just to keep my relationship with them, because you never know when the next one might come along. But I wouldn't take a big position. So let's talk about the IPO. So the IPO is where you're further down the road, and it's usually offered by the broker. And so you can just go to the web, sec.gov, and look at the S1 filings, the registration statement, and you can glean a lot of information from that. And when you do, there's some key things to ascertain. First off, think about your own position at the brokerage firm. Now, if you're a big broker, a big client, you've got a lot of money with the broker, and they come to you and say, "Hey, we're doing this IPO, it's hot." Most likely it will be, and most likely you want to take what you can get. But if you're just a small retail broker, small account, whatever that might be, 25,000, 2,000, 10,000, and they say, hey, we've got this great deal. You can have as much as you want. You say, "No, thank you," because they can't sell it. Now, if they come to you and say, and you are a small retail investor, and they come to you and say, "We're doing this IPO, you can have some, but just a very small amount." Probably what is happening is they need distribution. They need a certain number of shareholders to take the thing public. And so I would take that. If I can only get a little bit, then I know it's in hot demand and or it's a tight deal and it'll probably do well. But the other thing to look at when you're doing the IPO is how much are they raising and how much are the insiders selling. Because when you're an insider, you're an affiliate, you can't sell your stock unless it's been registered. And it's very difficult to register your stock. There's a ton of restrictions that you are subject to. So if you include part of your position as a founder in the IPO, you can sell your stock freely. So, and don't forget, when it's a registration statement, the stock will be free trading, filed under S1. That stock's free trading. So you want to know how much stock is being done and like who's taking it, if it's big institutions or if it's broad retail distribution. If it's broad retail distribution, you don't want to be part of it. And if it's, a big portion of the offering is the selling shareholders getting the right to sell their stock, you don't want to touch that either, because it's going to go down, or it's not going to go anywhere because it's going to be a huge cap on the market. But if it's an IPO that is tightly held, they've got good promoters, the idea is, or the company is good, There's there's a market for whatever they're doing. It's not just the next best thing since sliced bread, but going into a market that's already dominated by big companies. Then you can there's room to take those kind of IPOs. But the key thing is, where are you in the food chain as a retail investor, and how much stock can you get? If they're offering you a lot, don't take any. So there you go. There's some strategies on IPOs and the pre-IPOs.